For those who are just joining us, as I said, karibuni sana. We are starting probably in the next 2 minutes now. Feel free to introduce yourself on the chat box. I can see Mary has started us off. I will be throwing in also some poll questions as we proceed. I'll be your moderator or your host today. My name is June Mwangi from KEPSA. I know most of you, we have interacted one way or another, but in this session, I hope it will be as insightful and as knowledge sharing as possible. We have our speakers already joining us this morning. They are already on call and on time. So also a big and hearty thank you to them. We also hope to keep time so that we are able to go back to our businesses since we are business people, and also go back to it with a lot of knowledge and nuggets on how to take that up. Asanteni sana. For those who are taking their time to introduce yourselves, I'm just sharing the program and how we are looking at having it flow, and ensuring that we have captured different segments of this session as well. So I know a lot of people will still be streaming in as we proceed, but we would like to keep time as well. Asanteni. Okay, so I think we can start. I want to put my camera on so that we're able to put a face to the person who's speaking behind the microphone. As I said, for those who had joined in, just position myself. Yes, my name is June. I know the camera is a bit that is. My name is June or June Mwangi. Karibuni sana. Thank you for joining us today, and being able to share these nuggets and learn as we proceed. I want to launch a few questions here so that we're able to boost some engagement even as we dive right in. Our topic for today will be navigating business loan repayment. We have our partners here with us, World International and Equity Bank. I know a lot of you have heard about Equity Bank before, and also most of you have heard about Wild. So today will be for you to get to know more about what they do and also their perspectives on how do you navigate a business loan as an entrepreneur. Some of us, we also take personal loans, but we put them into business because maybe you and your business are one. So how are we able to tackle that and see how that plays out? But even as we start that, I just want to launch a question to all of you, just to hear your sentiments. On your screen, you can see a question that I have just put out there. We are just completing the first 5 months of the year. So just select your answer. How has business been for the first 5 months of the year? Luckily, this poll is anonymous, so I cannot see who has voted what where. And since I know we have 25 of us here, feel free to just make your decision. And yes, and make your choice. I'm not seeing anyone who's saying good so far, but fair is also a very good response. Okay, 14 of you. Let's continue voting. How has business been for the first 5 months of the year? The finance bill is also about to come, so that will mark the half mark of the year. So how has business been? Are you doing badly? Are you doing fairly? Fairly, comme ci, comme ça. It's just there. We are maneuvering. We are taking it a day at a time. let's give our choices, our opinions. If you can't see it, it's just on your screen. Feel free to respond to it. Okay. Going once, going twice. I am about to close the poll. If you have yet to respond, I'm about to close it. Okay, so 27% of you, or 4 of you who have responded, are saying bad. Really, really sorry about that. We hope that the rest of you will bring good tidings. And 11 of you, which is 73%, are saying fair. So it's been a mix of both. That is lovely to know. Okay. Let me launch one more question, even as we see how we are engaging. Have you ever taken a loan to boost your business? Have you ever taken a loan to boost your business? Sometimes you have an order that's coming and you need some quick cash, you fuliza, or you go to your bank and you get an overdraft. So have you ever done that? Okay, some of us have not. Let's keep our answers coming. Have you ever taken a loan to boost your business? It could be to expand, it could be to add stock, it could be to pay your suppliers. Oh, the no's are becoming bigger. Okay. Maybe some of us are also afraid of the loans. Just make your choice. It could be to pay your staff. Maybe business is not doing as well and you need some money to pay your staff because you don't want to let them go. So have you ever taken a loan to boost your business? Okay, so I want to close it, going once, going twice. I know there are a couple of you who have not yet voted. Just pick an answer based on your thoughts or your current status, and then we are able to see that as well. For the 6, I'd be very, very interested to know why exactly. Is it fear or what exactly is the case? So I will be ending the poll at that point. So 67 or 12 of you who have voted have said yes, and 6 of you that have said no. Okay. Asanteni sana. So okay, so sorry about that. Let me just take you through what KEPSA is, or let me stop sharing that. Or what does KEPSA do? So KEPSA has been in existence for the past 23 years, I want to say. Yes, 242 now. Yes, 21, 22 years actually, where a lot of people think we are government, but luckily and unluckily, probably we are not government, but we are a private entity. But I want to focus the discussion on what we are tackling today. SMEs or business people. What does KEPSA do for SMEs or business people? KEPSA supports entrepreneurs through different initiatives that focus on 5 areas. Either 1, access or linkages to finance. Secondly, access or linkages to markets, be it locally or external markets. Thirdly, capacity building, which is one of the initiatives we are doing here today. How are you able to maneuver? That's why we have Equity here to tell us, are there some things that when you feel like you're facing challenges with a loan or a facility you took, how are you able to maneuver? And we have Wild here to tell us, how do you know what your business can support, what your cash flows are able to take up and support? And that is also just coming up to capacity building. We also focus on matters policy because being in a country, policies are released that support or do not support business. So how are we able to ensure that there's an enabling environment for you to do business? And then lastly, we support innovation, where we also run annual hackathons or innovation challenges just to be able to award enablers, SME enablers, and SMEs who are doing business in a very innovative way. I know some of us have engaged with us in different of these initiatives, be it our benchmarking tours, be it our trainings, be it our financing arm. So we are here today just to discuss something very different. How are you able to position yourself better? How are you able to navigate the nuances, the pros and the cons of a facility to ensure that your business does not die up in the first 5 years of business, and you're able to also use that to continuously grow your business. I was sharing the program just to ensure that we are keeping time. So That is what we do as KEPSA for small and medium enterprises. We do all that in those focus areas through different initiatives, which you continuously see through our platforms on WhatsApp, on LinkedIn, Twitter, and all that, as well as we have all other support initiatives for corporates, bigger entities. How are we able to support you to grow your business, to do business-to-business matchmaking, networking opportunities as well, and so much more initiatives and activities. I think at this time, I want to welcome our speakers for the day. Our speakers for the day are two gentlemen who are a power force. You have definitely seen them in the fields because we are all in one ecosystem, in one sector as well, in an aspect to support small and medium enterprises, or you as a business owner. They work at different fronts, and they will be telling us just an introduction of what their entities do, even as we dive into the segment of what we have. If you have any questions, feel free to also drop them on the chat box and we will tackle them as well. I would also want to know, what are your expectations? What do you want to know about how to navigate a loan you have taken for your business? What do you want to know? What is one thing you are not told that you want to seek clarity on? So feel free to drop that on the chat box. And I know that I have supporting teams who are also logged in, will be able to support us and support me through tackling this session. So at this moment, allow me to invite one of the speakers to just give us an introduction on what Wild International does, and then we'll go next to our next speaker. These are our speakers for the day is Mr. Kirinya Kithinji from Wild International and Mr. Collins Wanyonyi from Equity Bank. So over to you, Mr. Kirinya. Just welcome, tell us about Wild, just for a few minutes, even before we jump into the session.
Well, thank you very much, and great to be here. I hope you can hear me. I'm loud and clear. Excellent. All right. So my name is Kirinya Kithinji. I am a director at Wild International. So I'll talk a bit about Wild International. So we are an entrepreneurship support organization based in Nairobi. So our focus is small and medium enterprises. So what do we do for them? We just help them figure out what their business models should look like, what they ought to do once we understand their business models. So our core product really is just strategy. And when I talk about strategy, really, it's how should they respond to opportunities or challenges that they experience as businesses. So we also have a bit of a focus on the owner manager, the person who actually drives the business, in the sense that we ask ourselves, what kind of decisions do you need to make so that at least you guarantee the success of your enterprise. At the point when you're starting off, there are certain decisions you need to make. When you begin to grow, there are also certain decisions that you need to make. When you've matured, there are also certain decisions that become front and center. So we've been working with small enterprises for all of 21 years this year. For us, it's really a privilege to be able to join this kind of conversation and share our experience in terms from, let me just call it bottom up, from the SMEs backwards, because my colleague Collins is going to share from the bank going this other way. So, and I'm hoping that this will be a beneficial session for all of us. Thank you very much, June.
Thank you so much, Mr. Kirinya, for the brief introduction. I know people are now excited to hear more about Wild. I think at this point, I'll welcome Mr. Collins Wanyonyi also to just tell us what Equity is doing as well from an SME perspective, and share more as well, even before we dive into the session. Karibu.
Thank you so much, June, for welcoming me into this session today. My name is Collins Wanyonyi, Director for SME Banking at Equity Bank Kenya Limited. We pride ourselves as the bank that solutions for the SME. And we look at SME services, how we position ourselves in three lenses. So the first one is on we call it the commercial angle, which is both bank and insurance. So we serve our customers from a banking perspective, just providing intermediation. Intermediation in simple terms is receiving deposits from customers and providing loans to alternative customers. So that becomes our main responsibility. And as we do that, we then facilitate your collections of money and payments of money from your bank account. Those remain our primary responsibility as a bank. And we pride ourselves that for the last 40 years, we've been able to solve for SMEs. Aside from the banking side, we have a supplementary engine that we call Equity Group Foundation. Equity Group Foundation then comes into the engagement with 7 levels of engagement. The main drive for Equity Group Foundation is provide capacity building and training for SMEs within the entrepreneurship leg. We also get into the education, and I'm sure most of us do align with Wings to Fly, and that Equity Bank does. And to date, we've done about 65,000 students. We also are strong in agriculture, and we've supported farmers towards just building and ensuring that what we call from farm to fork arrangement is done conclusively. The new entrant that we brought into our fold is sustainability, and the bank is playing aggressively into the renewable energy space, just to look at how do we position ourselves to solve for the ecosystem. For example, last year alone, we were able to plant about 100 million trees. And that is just how Equity Bank is contributing to the environment. I'll share more when I'll be speaking about what we do for SMEs specifically with Matters Loans. Back to you, John.
Thank you. Thank you very much. I was going to say, what is this Wings to Fly? A lot of people know about Wings to Fly. Maybe some of us even are beneficiaries, but I don't think there's anyone here who is as young as, I don't want to say me, but not to burst the bubble. But asanteni sana just for taking us through and a snippet of what Equity does. The session will be a panel session, so I will be firing some questions your way so that we are able to get to know how are we able to navigate loan repayment as an entrepreneur. As I said, I'm opening for all of you who are in attendance. Feel free to just shoot any questions that you have on the chat box so that we ensure that we have a coordinated session and it flows very, very well. I think I'll start with my first question to Mr. Collins. What are the key factors that Equity Bank or probably other banks consider when analyzing a business credit application? What are some of the key factors that they look at when you're analyzing? Assuming June comes and is applying for a loan, what are some of the factors you look at?
Thank you, June, for that question. People relate with banks for loans, and that becomes a critical piece. And whenever I speak to customers, I always tell them, when you're going to the bank, don't call what you want. Don't go and say, I want an overdraft or I want this, because different banks call different solutions different names. So what you might be, when you go in there, and I must admit, not everybody in the bank is agile enough to give you the solution that you want. So my starting point always is, don't go to say to the bank is, I want an overdraft. No. Go to the bank and say, I want money to do this. So if you want to buy stock, go to the bank and say, I want money to buy stocks. Because the moment you go and say, I want an overdraft, then the first instinct of the person reviewing your discussion will start just locking you into an overdraft. But probably you do not need an overdraft. You need a different solution, because when I look at equity perspective, we've got cumulatively about 67 types of loans. So when you come and tell me you need this kind of money, I'll go to the shelf. It's like a doctor. I'll go to the shelf and get the right type of antibiotic I need to give you for that facility. But that notwithstanding, there are about 14 conventional parameters that we have to look at when we are considering a customer for a loan. So one is, are you giving me security or collateral or not? Because that determines to what extent I can be able to extend your facility. There are loans that I can give you without security. There are loans that I must have some form of security to give. And then there are some loans where in the structure of the loan itself, it gives you security. So I'll give examples as I progress. So if you come in to get an asset finance motor vehicle, that motor vehicle becomes its own security. So I will not ask you for additional security. because I buy the vehicle for you and then I take the motor vehicle security. And there are some, and those of us who've interacted with equity ecosystem banking, we call it easy loan. We use your turnover history as your security. So we don't ask you for additional collateral. So for up to 10 million, based on the history of the records of the purchases you've been done with a specific anchor, we're able to give you up to 10 million on an unsecured basis. So that equity looks at collateral as the first aspect. And collateral does not just have to be land. So we use those various options that I've shared. The second piece is business experience. For how long have you done that line of business? The minimum we would prefer you to have done the business is 2 years. Why 2 years? We'll have seen your cycle as a business. What was your high? What was your low? What are the dynamics? Research has said, and Kirinya will come here, he's done it better. Research has shown that most SMEs do not survive the second year. So based on that research, we then say, can we look at you after the second year? Because that means the chances of you progressing will be high. So we use business experience for that second year. And this is where we also put in a play. So for example, and allow me again to use my good friend Kidinji on this call. He's been running a school as a principal of the school, but he was not the owner of the school. So can I use his 2 years, 3 years experience as a school principal to finance him for starting a school? Yes, because he was the one administering the school. So he has a good experience of running a school, in as much as he was running a school as an employee. The third piece is we look at your account behavior. So account behavior is what people call account turnover. And there are 3 parameters I want to share when it comes to account behavior. We have one customer who deposits money in the morning and removes money in the evening. So that is one character of a customer. Then I have another customer who deposits money in the evening and removes money in the morning. That's the second character of a customer. And the third customer is a customer who deposits money on Monday and does not withdraw the money until Friday. In the eyes of the bank, these 3 customers have different risk profile. So the customer who deposits the money in the morning and leaves the money in the evening is taken to be a little bit of a high risk because that money has to move as fast as possible. And those are not the customers that the bank really loves, because it means that you have a quite of a challenge of how much money you can retain. However, if you're a customer whose money can sleep in the bank for at least one night, then the bank starts having comfort. And remember, that night you are not doing business. So it's actually easy to bring your money to the bank in the evening, let the money sleep in the bank, just the way you sleep in your house. Then in the morning, take the money to go and do other business. That's what I'd encourage you. The safest customer is the customer who deposits money on Monday and comes on Friday. The bank treats that customer as less risky because it shows that that customer has ability to retain their deposits longer. The next item we look at, depending on the type of organization, is your audited financials. In the audited financials, we would like to see how the business has been performing the last 3 years. And the auditors will always give a report, a one-page report on that audited financials to then say, have you done the books of account, have they been done well or they have not been done well? That statement is something we really look forward to read. It starts, depending on how the auditors have written that one page, determines whether we'll look at the entire audited financials or not. So depending on that one paragraph that the auditor will just say that June's books are done in a good way, then you can continue reading page 2, 3, and 4. If page 1, they've said they have questions in terms of how June has done her books, chances are I might not go to read to page 2. So audited financials becomes a critical item that we need to look at. But if you do not have audited financials, that exercise book where you write your business records can still work. We will look at how you've bought in your stocks, how you've sold your stocks, how you've received money, how you've taken out money. In that simple exercise book, Karatasi brand, I remember when I was in primary school, that was the brand that was most famous, 32 pages exercise book. If you're using that book, or when I was in kindergarten, my mother used to cut my exercise book into 2 halves. If that is the book you're using, that is the same record that we will use for picking up that record. The other thing that we also check is Credit Reference Bureau Report, CRB. When we check on CRB, we then check, have you paid any loan more than 30 days late? That becomes a critical piece to then look at. Has June paid all her installments on time, or has she had some loans repayment? So the CRB report is not about blacklisting you. I know people say I was blacklisted in CRB. CRB is not about blacklisting. CRB is about giving a profile of your credit history. And from that profile, we then decide how we look at. So the most critical information on the CRB report is not actually whether you've paid the loans well. Usually on the top right corner, there's a score that the CRB Bureau gives you, A, B, blah, 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 and all that. So it starts from AA, it continues. I think it's triple A as you continue down. That score becomes a very critical piece for me as a bank when I'm reviewing your ability to repay. So you might have paid 90 days late, but you have a very good score up there. So that is one of the items we check. And then as we continue to look at, there are two items that we then look at from a basic understanding. One is your installment to the income that you pay. So if you're making income of 1,000 shillings and the installment is 100 shillings, then we say you have ability to pay, because the installment to income is 100 shillings over 1,000 shillings, and that is about 10%. The moment your installment to income goes to a number above 15%, it means the chances of you paying that loan is getting smaller, because remember, when you sell 1,000 shillings, it's not the entire 1,000 shillings that is profit. The profit is a small portion of 1,000 shillings. So installment to income is trying to limit our lending to just the profit that you made from that business. And since you eat from that business, I have to leave you something to go and buy mboga for your children. So installment to income becomes a critical piece for me to limit my lending to the reserve amount out of that turnover. So installment to income becomes very critical. There are some businesses that you may not have clarity on income. Then we use installment to turnover. Then we say, if your turnover is 1,000,000 shillings, can I take up to 20 or 30% of that turnover to be installment? So there, at that point, again, we use just your total turnover and then look at what installment amount. Using those two items, it becomes very critical for you as a customer to actively use your bank account, because I may not have all the records that you have for the business, but I can just use the turnover report of your bank account to use that data to give you a loan. The last piece that we then look at is what we call debt service cover ratio. It's a lot of English, but what it just means is when you look at your installment and you look at the installment, assuming you have an installment of 100 shillings and your business is making 500 shillings. So your ability to pay that amount is 5 times, because it's 100 divided by 5. So the more times that number becomes smaller, the high chances it means you can pay that loan. And the moment that is starting to look bigger, it shows the chances of you to pay that loan is limited. So if debt service cover is closer to 100%, it tells me, Kirinya, you cannot pay this loan. But when it becomes lower, it means you can pay that loan. The last piece that we look at is credit guarantees. So there are various organizations that have come into play to provide guarantee schemes to support SMEs. Most often, you've heard of the IFC, International Finance Corporation, that have done. We've seen the JIRA that was done between MasterCard, and I think it was with KEPSA. There's a MasterCard guarantee scheme that was done. So those also come into play. And the good thing about the guarantee schemes, they give the minimum criteria of what you can be able to do. So in summary, all those items I have mentioned, in bank terms, we call it risk acceptance criteria, because that is what it comes to then say, how much risk can the bank take? And how do we analyze risk? On a very simple terms? We all have friends. A friend will call you and say, June, can you lend me 1,000 shillings? There are some friends, when they tell you, can you lend me 1,000 shillings? You'll quickly go to M-Pesa, click, put the number and send. But there are some friends, when they tell you, June, can you lend me 1,000 shillings? You start asking yourself, these Collins, can I send him? No, let me not send him 1,000. Let's send him 500. That is the same way the bank thinks of you the moment you come to bank to ask for a loan. So where do you want to place yourself? Do you want to place yourself to that person who the bank said, I'll just give the money quickly? Or are you the person where the bank will say, let me think about it. Let me give June a small amount. Finally, June, there are two things we look at. Just like an antibiotic, too much of something is not acceptable. Too little is also not acceptable. So if you come to ask for money, I can't give you too much of it because just like the antibiotic, that's not acceptable. You might, as people say, you might go and marry another wife. So we don't want to tempt you. And also, when the money is too little, then it means it may not have an impact on your business. So then the best thing then to do is not to give you that money because that money might not make an impact to your business. So in a summary, June, those are some of the criteria we look at from a bank when you're considering customers for loans. Thank you.
Thank you, Collins. You have briefly and specifically put my friends asking for 2K urgently. So I don't know whether those ones are the high risk or I group them under low risk. But I can see also Mr. Kirinya is nodding his head because this also aligns with matters managing and looking at your business inwards even before you borrow. I don't know whether Mr. Kirinya, you have something to add on that even before I fire your question away.
Well, I think Collins, my colleague Collins, is absolutely spot on. And you've noticed I've been nodding my head throughout. But Collins, what I liked is what you said about the account turnover. The person who withdraws money at the end of a day and after a week, that's pretty insightful in terms of determining the cash inflows and outflows of the business, and of course the risk profile. Yeah, Collins, very, very informative. And I'll keep nodding my head as you speak.
Maybe now it's time to switch roles for him to nod his head. But I think a question we have is, what
Yes.
practical tools and strategies can an SME use to or adapt today to improve their cash flow forecasting and align their loan repayments with their business cycles? There's something Colin said about their debt to recovery or debt to service, debt service cover.
coverage.
Yes. So how can an SME ensure that their cash flows are aligned to their loan repayments, like their business cycles? Maybe you can tell us.
All right, June. So really forecasting is really about thinking ahead about your inflows and outflows of cash. That's pretty much. But you need to do that as accurately as you can. And then you need to follow up on what you see. So you're looking ahead, how much money is flowing in, how much money is flowing out, let's say for the next 1 year or so. Then they need to be as accurate as possible. And after that, what do you do with what you see? If, for instance, your cash flows tell you that in between November and December this year, you expect a very serious dip, and you've already taken a loan, what's going to be your response around that? So I also want to say that whenever you take a loan, you are, in a sense, increasing the claims of third parties on your cash flows. And my colleague Collins already has alluded to that debt service coverage ratio. So before the banker comes in, before Collins comes in with his loan, assuming that you've scored all the points around the criteria that he's given, you already have other third parties with a claim on your income. Yeah. And I'm talking about people like suppliers of raw materials, your rent, for instance, your marketing costs, your salaries, and things like that. So then the loan repayment installment then becomes an additional outflow of cash from your business. So the question is this: is the business able to bear that extra outflow of cash without straining itself? Now, That is a definition of the debt service coverage ratio from where we sit. But I think when it comes to cash flows, SME owners tend to fail in two main areas. Yeah, the first is not preparing the cash flow forecast rather. The first is not preparing the cash flow forecast at all, even the most basic one. I expect to receive 100,000 every month over the next 6 months, and I think my expenditure will be about 80,000 or 90,000. Even just that rule of thumb. So that failure is very common with small and medium enterprises. It's kind of like they wake up and decide what they want to do. Now, the second failure, and I think I'll spend a little more time on this one, is at the assumptions level. All cash flow forecasts are built on assumptions. And if you get these assumptions wrong, you will definitely struggle to pay your loan. All cash flows forecasts are built on assumptions because you're talking about tomorrow, not yesterday. Yesterday has already happened, and I can see that you already put in 100,000 in your account. But what about tomorrow? How do I know that it will be 100,000 or 200,000 or 300,000? So because we are forecasting, we are already in the space of assumptions. So in terms of inflows of cash, we know that the principal source of inflows of cash is your sales, income, rather. So you're telling me that on Friday you expect 100,000, on Saturday you expect 200,000, and so on and so on. Okay, I agree. But what are the assumptions behind that? For instance, if you're selling products, you're telling me in effect that you're going to sell goods worth 100,000 on Friday. So what is the quantity and at what price, for instance? And what makes you think you're actually able to sell that quantity and that you'll also be able to get that price at which you're projecting? Now, I want to say this also. The principal source of repayment for your loan is your sales and nothing else. So if you're not selling, you'll have nothing to pay as far as the loan repayment is concerned. So you'll have all your projections looking nice and shiny and very impressive. But at the end of the day, if you're not selling, where are you going to get the loan? Where are you going to get the money to repay that installment that is due at the end of this week? So my point is this: assumptions are absolutely critical when it comes to forecasting. And it's a big failure, at least we've noticed as an enterprise support organization. When people are doing their forecasting, they tend to do their forecasting to impress Collins, so to speak. Oh, we can do this, we can do this. This is actually where we are going. We're going to treble our turnover in the next 3 months or something like that. They're just doing, it's an academic exercise, so to speak, to fool Collins. But you see, Collins already has your records. He's already able to see what you've been doing for the last 2 years or 3 years or 4 years. And now you're telling him you want to move your turnover from 1 million shillings a month to 100 million shillings a month. I'd like to say, what are the assumptions behind that? What are you going to do differently to move from 1 million shillings to 100 million a month? You can see that's a very big climb, and it's been driven by assumptions. So, June, I'd like to say, if you get your assumptions wrong, especially around revenues, and of course their expenses, because expenses is money leaving the business on a monthly basis. If you get those assumptions wrong, especially on sales, you're going to struggle with your loan repayment. June?
Thank you, Mr. Kirini. I'm just typing the answers here because I also want to take notes because maybe I'm also trying to impress Collins, me and your school. We want to see Collins behind the tent. But I want to tie that question because you've actually just tied the next question I had, which, how can a business person identify early warning signs of financial distress? And what immediate steps should they take to avoid a loan default? What are some of the early signs that a business can detect or identify on financial distress? And what should they do?
Wow,
because Collins
excellent.
will come and probably he wants to close the business because they have not paid for a year, because he also needs to recover. So how are they able to also, how do they identify, and what steps to avoid the default?
All right, thank you, June. So for me, the mother of all warning signs is missed sales projections and missed timing of expected income receipts. For me, that's the mother of all that. So, because the thing is this, remember, I've just alluded to the fact that your loan repayment installment comes from what you sell. It does not drop from the sky, from nowhere. It doesn't parachute into your business. It comes from what you sell. So for me, the mother of all warning signs is that you have missed your sales projections and the timing. For instance, you are projected to receive, say, 100,000 by the end of May because you've been selling 10,000 every day or something like that. Now, if you begin to see that on a daily basis, I am not going to hit the sales projections that I expected, then that's already an early warning sign because there is nothing to bank. And if there's nothing to bank, of course, you're going to miss your loan repayment, and you're going to have a very different conversation with Collins from the initial one when you're trying to get the loan. Now this one will be very, very different. So that's the first warning sign in terms of what? Missed sales projections, and then the expected income receipts. Now, I've alluded to the fact that loan repayments actually comes from sales and collections of invoices. So I have some practical questions to ask. The first practical question is, when was the last time you invoiced? Is it like 20 years ago or yesterday morning? Yeah, when was the last time you invoiced? And the point is this, you cannot invoice if you've not rendered a service or sold anything. And you cannot sell anything if you don't have a client. And you cannot get a client if you've not been sourcing for those clients wherever they're supposed to be found. So there's a sequence to that. So that's why sales projections is a big one. Missing your sales projections is a big one for me. And then remember, I've just alluded to the fact that your projections are they're driven by assumptions. And you can begin to see where sales projections are a big discussion in terms of missed loan payments. So loan payments come from sales and the collection of invoices. When was the last time you invoiced? And if you have invoiced, when was the last time you've collected the money that you invoiced? Very, very important questions. And then there's another question we actually need to ask ourselves. Do you have a running surplus that you've been accumulating over time? This is May, for instance. We are coming to the end of May. Did you have a surplus in January? Did you have a surplus in February all the way? And do you expect a surplus at the end of this month? Now, those are very, very, very strong predictors, whether you're going to miss your loan repayment at the end of a month or not. So for me, the big thing is, have you been selling? It is a rule of thumb. You cannot sell if you don't have a client. And you cannot get a client if you have not been out there looking for them. And at the end of the day, you still need to invoice them. So that's it. That's what I can say, June. Over to you.
Hey, I'm also typing. So do you have a client? Are you selling? Do we have invoices? Are we invoicing? No, I don't want my house to go, because there's always a saying that, men, when they have a business and they are taking a loan, they will give the collateral as their house. And then me as the wife, I'm just seated and they have removed me and I'm not understanding what happened. So please let us not take loans with our houses as collateral. I can see the questions are coming in. Please continue dropping the questions on the chat box. But I'm back to you, Collins. How can SMEs, I'm just tying what Mr. Krinya was answering, how can SMEs engage more effectively with banks when facing repayment challenges? And do you usually have restructuring options that are realistically available to them? Because, sometimes people don't know that they can restructure their loan. So how can the SME engage you as equity or a bank when they are facing a repayment challenge?
Thank you, June, for that question. It reminds me, over the weekend, I was watching a conversation with Ndwati. Most people remember Ndwati of Resolution Health. And he's as successful a businessman that he is. He'd mentioned that he's been auctioned thrice. Is it thrice or twice? One of those items. And one of the things he said in that clip, if you go look, somebody can look for it on YouTube, he actually said it's one of the best lessons that he got from that. But I'll come back to the conversation. Banks are not out to sell your collateral. It's not amongst our core responsibility. So at any conversation, when we are taking the collateral to secure the loan. We are simply trying to abide with the Central Bank of Kenya prudential guidelines that says before you give June money, you need to ensure that there's something to lay back on. So collateral is not just land. And most people, whenever you say collateral, the first thing people think of land, think of houses, think of their domestic houses. That's not the only item about collateral. So what happens? So Kirinya has mentioned the moment you realize you are falling short of your projections, you start foreseeing a problem. So when do you start talking to the bank? That is when you start talking to the bank. Don't wait until you default on the installment. The moment you realize your sales projections that you said you'll sell 10 houses a month, you've only sold one house and you have 100 houses to sell. At that point, you visit your bank and say, Mr. Bank, I have this challenge. I foresee this will be the problem. We've seen large corporates going to the newspaper and say, giving an profit alert to just tell people, we've looked at our books and we foresee things will not be well. So that is what I encourage the banks. And when you then go to the bank to alert the bank that things are not well, you need to have a plan. Don't just come and say it's by grace of God. We know God takes care of all of us. So you have to then show the bank what's the plan. So what is your plan B? What's your plan C? And the bank will have a conversation with you. And it's at that point that the bank will restructure your loan. Now, there are two levels of restructuring. When we are having a conversation to restructure your loan before you need to go into arrears, it is an easier conversation because at that point, you've not gone into the non-performing loan category. And this is why. The moment you go to a non-performing loan category, the Central Bank of Kenya has given guidelines of how I'll handle you. And if I don't handle you in that way the Central Bank guidelines has given, as a bank, I'll be penalized for doing the wrong thing. But if I deal with you before you go to non-performing, it is between my mutual understanding with you. So that is one primary reason I ask customers, please visit your bank to discuss restructure before you start getting into arrears. Because the moment you get into arrears, prudential guidelines jump in. And that question then becomes very critical for you. How? So after you go into arrears, the law comes into clear. So for example, the central bank requires that if I'm to sell your house, how many days do I need to give you? If I'm to take your stock, how many days do I have to give you? So those are the rules that come in. But June, allow me digress a little bit. Our individual loan repayment are the ones that make how expensive loans become. And I'll ask our audience to just pick out a calculator on your phone and work this in 2 minutes with me. You have 1,000 shillings to lend to 10 people at 10%. You have 1,000 shillings to lend to 10 people at 10%. So everybody will be paying 110 shillings, right? Then 4 people decide they will not pay. Remember, we still have to get to our 1,000 shillings and 100 shillings because the bank prudential guidelines insist that the bank should not lose money on the potential customers. Otherwise, customers will run away from the banks. So what does the bank do? The bank has to find a way to put a burden on these other 6 people to cover the potential loss of the 4. So remember my risk acceptance criteria discussion earlier. The risk acceptance criteria comes and says the maximum loss we can take in this arrangement is this level. So assuming we then say the maximum loss we can take is 4 people not paying out of the 10, I will factor that loss into the pricing conversation. So instead of June, you paying 110, that interest, I have to divide that 440 divided by the 6 people. So that these 6 people carry the burden of the 4 people who are potentially run away. So what will happen is the interest rate that will potentially have been 10% goes higher because now the installment then moves from being 110 to maybe 100 and yes. So that is, so whenever I meet customers, I ask them, please, ensure your loan installments are done well so that your brother and sister does not have to pay a higher installment because of what you did yesterday, because we will use previous default history to allow and say what will be the pricing conversation. I thought I need to bring that into the conversation for our audience to understand. Back to you, June. Thank you.
Thank you. I think one thing or a statement I've taken is that you've said grace of God is not a strategy. Probably somewhere means you need to have a plan B. If you feel like you've missed your projections or your self projections, reach out to the bank before the installment date is there. Otherwise, then it will start being a loan in arrears. I think that's correct. Is that correct, Collins?
That is correct.
Performing loans. Okay, so let me just see. I know the questions are really streaming in. We will tackle them, and we are going very well on time. So let me just throw back that question to you, Collins. So if you said we have two restructuring options. If that person does not have a plan B, what happens? I've missed my sales projections, as Mr. Krinya says. I don't have a surplus set of money somewhere. I've just come to you and I'm like, the sales are not, business is not looking good. Like the way people who are doing plastics, overnight there was a plastic ban, and probably someone had gotten an asset financing loan and they don't have a plan B. So how do you help? What are the restructuring options available that are favorable to an SME, just to ensure that they cushion their business?
Thank you, June. The moment you fall into arrears, then any restructure discussions are governed by the prudential guidelines. The central bank prudential guidelines are documents, it's a public available document, and I will encourage anybody with a bank account to just go and get just go to Google and put prudential guidelines and it will come. So the prudential guidelines from central bank, being an open document, is actually what governs how banks will relate to their customers. So when it comes to your non-performing facility, the prudential guidelines will then come to inflict how do I do. So there are three items. So the first one is the prudential guidelines allow me to restructure your facility not more than once in a year. So in any cycle, prudential guidelines limits me to once in a year, at most two. So the moment I restructure your loan more than twice, then that is a breach. The central bank will then say, the moment you've restructured a loan once and at least twice within that year, you have to go into to qualify that loan as a non-performing loan and then go in to recover collateral. So that is number one. And as I said, that one is not the bank thinking, it's the central bank governance structure. The second piece then is there are two levels of engagement when then I move into realizing collateral. When it comes to realizing collateral, there's either forceful realization of collateral. Forceful realization of collateral is where I must get an auctioneer to come and grab these collaterals from you. I'm saying grab because at that time it's literally a fight to get it, and then go store it somewhere and then dispose. So that is one leg that goes into. The other leg is mutual understanding. So if I'm here and June has her car that she's failed to repay, and it comes to a point where we need to sell it, you can actually take it yourself as June to a person who sells cars, and you enter into a private treaty with the seller and then bring the money to the bank. That is also an option. So we are not boxed to you insisting that the bank has to grab, and you can actually go and sell. If it's your house, you can actually go and put up an advert of for sale, and you personally walk through the journey of selling and get a buyer. And that is what in the banks, in the legal term, we call it private treaty, where you enter into those conversations. So when it comes to matters realizing collateral, post, the moment you're in arrears, even for one day, the prudential guidelines chip in. And that is why I encourage customers. When it comes to restructure, please come before you're in arrears for even one day. Because the moment you're in arrears for one day, I must play by the rules of the prudential guidelines. But if you come before you're in arrears for a day, I can restructure 4 times, I can restructure 5 times, because at that time, the regulator is not looking at it. But the moment you turn into arrears, that is a record that I must update the regulator regularly. That does not mean that even on this other side, I can just keep restructuring anytime you come. There must be what Kidiji told us earlier. There must be a plan. There must be a documented forecast that we can be able to rely on. So if meteorological department has said there will not be rain, and then you're coming to tell me your plan is based on rain falling, you can realize that there's a misalignment. So those are some of the items we look at when it comes to repossession and disposal of assets.
Thank you. Thank you so much. I'm seeing my colleague has even posted the link to Peter and what you had mentioned him. It's a good learning case, but these are things that we did not know, that you don't make the decision. People think banks wake up and feel like they want to take the car, and it's good to know that you are also governed and you have guidelines that you do follow, so that people are not, we are very quick as Kenyans to bash and throw the stones at the person. But thank you for shedding that light. And I hope that as audience, we are also learning and getting to know a few things that we did not know. Thank you so much, Mr. Collins. Back to you, Mr. Kirinya. I want to ask a question on matters mindset. We talked about, because sometimes you feel like maybe I don't want to, I'm ashamed to go back to the bank, and I had very good revenues, and now I don't want them to see me or my credit officer to see like my business is not doing well. And those are some of the things that put us in some of the binds that Collins is talking about. So what mindset shifts or day-to-day practices that SMEs need to adopt to build a culture of financial discipline? You also talked about the surplus, what was it called? Let me just refer to my notes.
Running surplus.
Yes, the running surplus. How long of a running surplus should one have? And at what point should one start saving some, and what percentage? Because those are things I'm wondering. I'm here saying probably I don't even have money to pay myself a salary as a business owner. And we are talking about a running surplus here. So at what point should they start? Is there a percentage that they say of a business revenue that you should put? And what are some of the mindset or day-to-day practices that need to shift to ensure that we are practicing financial discipline? Because we say, I think if you are a Christian, we say there's a verse that says, if you can't be trusted with little, you can neither be trusted with much. So tell us.
All right, June, first, let me just go back to the thing about the surplus and the very interesting thing that you're saying, that you're not able to pay yourself. For instance, I'm running a business for the last X number of years, but I've never been able to pay myself. It still goes back to the point, do you really have a valid business? Um, and is the business generating enough cash flows? Because there's a very strong link, June, between having a valid business model and being able to generate regular cash flows. There's a very, very strong correlation between the two of them. For instance, let me put it this way. If your business model is struggling, for instance, you don't have a product that the market is willing to buy, so who is going to buy the product? For instance, if you're not clear about the problem that your product or service solves in the marketplace, or if the market is very, very limited. So you can see there are some other things. So the fact that you're not able to pay yourself also triggers other questions in terms of why are you not able to pay yourself? Definitely it's because you're not being able to generate enough cash. And why are you not able to generate enough cash? So for me, it will just, I'll just ask, do you really have a valid business model? So it's good for SMEs to be honest with themselves and see they've been struggling for the last 6 months to generate revenues, even to pay salaries and to meet their expenses. Forget even the loan repayment that Collins expects from you. So it's a good thing to step back and ask yourself, do I really have a valid business model? That's a good question to ask. June, specifically to speak to the idea of I'm not able to meet my expenses. And the reason why you're not able to meet your expenses is that you're not generating cash. So my question is, why are you not generating cash? For me, as a person who works with as an enterprise support organization, I always go back to the business model and ask, do we have a valid business model? Because if you have a valid business model, at least in theory, it should be able to generate the cash that you the cash that will help you meet the business expenses. So how do you know whether you have a valid business model? Before I narrow down to your question, number one, every business is ideally should be set up to solve a problem out there in the market. So what problem are you solving in the market? First, the first question. And then the second question, is it a problem worth solving? I mean, for instance, I want to repair my phone. I mean, you set up a business to repair phones, and maybe there's only one phone in Kenya. Uh, does it really make sense? So is it a problem worth solving from a commercial point of view? And then, do you have a value proposition that actually speaks to the problem that you're trying to solve for me as your client? And then you need to figure out how you're going to get your next client, because I'm not the only one who needs to repair a phone. Maybe there are another 10 or 20 or 500 or something like that. Those are fundamental questions that you need to ask. And then if your business model is nice and shiny and clean and it's valid, we also need to ask ourselves, you as the owner of the business model, are you the right driver? Yeah. Are there some decisions that you need to make? Are there some decisions that you need to make that will help you take advantage of the opportunity? And of course, we define opportunity as a large number of people with a problem to solve. That's already an opportunity. And then, of course, you need to ask yourself, how are you going to survive competition? You're not the only one who is angling to solve that problem in the market. There's me, there's June, there's Collins, and everyone else. So business model. And then you as a driver, as the owner of that business model, do you have the skills to drive this business model to the next level? So that's how I look at it. But now to narrow down to your question, if you want to build a culture of financial discipline and proactive loan management within your teams, I think I'll begin by looking at the purpose of the borrowing first. Yeah. That's where you need to start, right? So why am I borrowing in the first place? And in our experience with SMEs, we found that many people who are going to look for loans, they're not able to distinguish between the nice to have areas in your business and the need to have areas in your business. Why do you want to upgrade your furniture in your office? And the same old furniture is still generating 100,000 for you in a month. So what difference is a new furniture set of 600,000 going to make to your business? That's a nice to have, but need to have is a very, very different conversation. For us, need to have areas are things like actually enable you to scale your value proposition, for instance, to scale what it takes to deliver your value proposition. So maybe better equipment or to upgrade your equipment and things that help you to acquire more clients. Those are need to have areas as far as your borrowing is concerned. So I'm saying I would start by looking at the purpose of borrowing first. Are you just borrowing for shiny things or you're doing need to have? So once we establish that, the other thing is part of financial discipline is to avoid borrowing to fund speculative ventures. And speculative ventures are exactly just that. It's either this or the other. And of course, the most famous kind of speculating is called gambling. So you're borrowing to fund speculative ventures. And these things could go this way or the other way. The other thing, the other aspect about financial discipline that we really need to take into account, please do not borrow money to fix poor historical choices, to fix past issues. So you borrowed money, you made a mistake, the business collapsed, then you go and look for Collins again and tell him, now, I want to resurrect that body that is in the grave. I want to resurrect it. So now you have two problems there, assuming that you get the money for some good reason or other. If that resurrection fails to take place, what happens? Now you have two problems to solve. You have a loan to pay, and then you have a business that is collapsed. So you're not actually able to pay the loan. So avoid part of financial borrowing is to be very disciplined to make sure that you're not dealing with nice to have, you're dealing with need to have things that enable you to acquire more customers, uh, to scale your value proposition, to survive competition, to scale your production, or things like that. In other words, what we're saying is you need to make sure that your borrowing enables you to take advantage of a real opportunity out there. So now that you have qualified for the loan and I have given a background, so the first thing then you need to do now to really narrow down to your question is you need to keep your projections accurate and keep retesting your assumptions. Yeah, don't prepare financial projections to hoodwink financials, really. So keep your projections accurate and keep retesting your assumptions. And then next, you also need to track your in and outflows. So that should enable you to keep your loan repayment, your approach to loan repayment proactive. First, to summarize, is it a borrowing that should have been there in the first place or not? And then are you borrowing for nice to have or need to have areas? Are you funding speculative ventures? Or are you borrowing to fix poor historical choices, to resurrect bodies that are long dead? Uh, my point is make sure your borrowing enables you to take advantage of a real opportunity. And then after that, then of course, go back to your projections and keep testing those assumptions. Are they accurate? For instance, are there some things that we need to tweak? And then of course, track your inflow and outflow. June?
Thank you, Mr. Kirinya. You've been very precise, straight to the point. I'm short of saying very cutthroat. You are not sugarcoating anything. But I think I just have a small add-on to add. Apart from matters financial discipline, are there things that contribute to poor financial choices? You know, you can say sometimes it's just a financial character. We have financial character. Are there other things in a business or from a business owner that contribute to some of these things, like having defaulting on your loan or your business not having a very clear business model? Are there some, you've talked about not having a business model. Are there some other things that contribute to such predicaments?
Excellent question, June. At the end of the day, when it comes to effective loan repayment, the truth of the matter is it is the business that generates the loan, the income to pay the loan. But, and this is where Collins is very sensitive towards character, of course. It is the person who owns the business who decides to pay the loan, because the money could be sitting in the account and refuses to pay the loan. So for us, those are the two areas that are absolutely critical in making sure that your relationship with the banks are fruitful. First, it's a business model, because that's where the loan repayment is going to come from, and then the owner. So to narrow down to the issue of financial management and literacy and things like that. So here we are pretty much just focusing on the owner herself. Now, here's the thing, June. Do you know that 87% of business failures are actually management failures? Yes. 87% of business failures are management failures. Now, the 13% is COVID, earthquakes, floods, locusts, and any other thing that you want to add. So what we are saying is, even though you have a correct business model that has a potential of creating another Equity Bank and another one, the way you manage that business can be the thing that actually brings you down. So the quality of the manager or the quality of the management is absolutely important when it comes to exploiting the potential of the business model. So now that we've said 87% of business failures are management failures, what is management? At the end of the day, management is about decision making. It's about decision making. So you can make a decision that brings down your business, even though it's valid, or you can make a decision that takes your business to the next level. So it's absolutely important for us to circle back to the person to the owner of the business and find out, what are your management gaps? How are you making decisions? Are you making decisions where you have no skills about? For instance, maybe I'm an expert carpenter and my business has started expanding. So I tell myself, I'm not going to to think about having an accounting system. For instance, let me just keep using my books because that's what I'm familiar with. But now you have one branch, another branch, another branch. You have 500 branches all using pieces of paper to keep their records. That's a decision that you have made. Yeah. So in a sense, some of the decisions that we make as owner managers, managers who own businesses, can actually make the business go down. So in terms of supporting the owner manager, really it's at the level of the decisions that they need to make. And remember, as an owner manager, I may be an expert carpenter, but I'm not good at HR. I'm not good at financial management. I'm probably good at customer relations, but I'm terrible at many other things that I need to succeed. But I am still making decisions about areas where I'm not an expert on. Yeah. And how do they make those kind of decisions, June? When you find yourself in an area where you are not an expert, use what we call a rule of thumb. Yeah, kupima na macho, that's what we call it. Use a rule of thumb. Now, rule of thumb simply means trial and error. But sometimes it can turn out to be error and error, not trial and error. You know what I'm saying? So I said you still have a valid business, but you are making certain decisions that will actually bring you down. So, as a manager of a business which I own, it is important for me to have at least some basic level of skill in terms of those other areas, whether it's client acquisition, whether it's just knowing how auditing works, even just basic information. And when I don't have that kind of information, I look for an expert to help me to do that. Over to you, June.
And I know Wild has a lot of these experts. I'm seeing Jesse is posting your social media pages, which these are some of the expertise you have: tax experts, financial planning experts. You have also business strategy experts. This is why we have Wild International in the room. Sometimes we say coaches don't play. You could be the founder, but it doesn't mean that you need to be the director or the CEO. You are the brains behind it, but running on a day-to-day implementation is not your forte. And that doesn't mean that that business is no longer yours. I don't know whether we should start tweeting. Colin started us with grace of God is not a strategy. Now you can be the founder, but you're not a good CEO. And I know we are wrapping this up. We are going really, really well. Thank you so much for the engagement. I have two last questions to fire away, as I'm seeing there are questions also in the chat box. Mr. Collins, over to you on your last question. How does Equity Bank support SMEs that show potential but lack formal financial records? When you are talking about what are the factors you look at, you either said your business records or audited financial statements. So how do you support SMEs that have a potential but lack those financial records? And what advice do you give such businesses to improve their credit readiness? If June comes to you, I have potential. My business is a solid, as Kirinya said, we are here to impress Colin so that he gives us the 10 million, but I don't have records. So how do you support them? And what advice do you have for them to be credit ready?
Thank you, June. Before I chime into that, allow me support Bwana Kithinji on some of the presentation that he was doing. And I just want to refresh some of the panel, the members on this engagement today. For those of us who've used Mombasa Road, you may remember that place called Devki, but people call it Devik, around that area. There used to be thriving petrol stations. I think there were about 4 petrol stations just around that side. For those people who come from Machakos, you might remember as you head to Machakos on the left-hand side. Then when the overpass came, those 4 petrol stations were killed, literally, because the road expansion ate into the petrol station. So if that customer had a loan, that is beyond the entrepreneur, totally. So it's not something that the entrepreneur will have known. And remember that road got into the private property. So the government took over part of the private property to create that road. So those are some of the instances that come to affect a business that the business will not have planned for in whichever way and form. Now, if you look at that area now, it's not as vibrant as it used to be, purely because of that construction. So I thought Kithinji, I will bring in a real life example of how business is affected. and then things just go. So you might have had solid plans based on 5-year historical performance, and you project the future, then bang, government comes and say, we have to put a road, we have to put an underpass here, and then all your 5 years good experience disappears under the drain. I thought we start with that. But back to your question, June. When I started, I'd mentioned around the 3 levers that Equity Group, under which Equity Bank operates under. And one of them was Equity Foundation. Equity Group Foundation has a segment under it called entrepreneurship and leadership training. One of the engagements that we do within that department of Equity Group Foundation is doing capacity building and training for SMEs. Actually, let me say MSMEs. So we identify MSMEs that have reached out to the bank and did not qualify for a loan by virtue of the bank's lending criteria. So when you come and make an application to the bank and we realize, based on the bank's parameters, you don't qualify. So remember the 14 parameters that are shared, you don't qualify. But when you look at that business, there's potential. So what does the bank do? The bank attaches you to the Equity Group Foundation team, and in each branch, we have an Equity Group Foundation officer who will then put you into a capacity building program on a personal one-on-one that supports you to build a business case to the extent that within a 6-month window, you should be able to qualify for our loans. So you come to the bank, you don't qualify, but when you look at the books of how you structured, there's opportunity for you to qualify. So you are taken to the Equity Group Foundation contact person within the branch to support you with the capacity building and to come back to work. How have we done that? We, in partnership with MasterCard Foundation, the second thing that we did is we also realized that the youth were being left out of some of the engagements because they don't qualify, one, because of age and just being new into the engagement. So in partnership with the MasterCard Foundation, we started a program called Young Africa Works. How does Young Africa Works? What does Young Africa Works do? It supports micro SMEs, and here I'm talking about micro, to get business acumen. And once they've gotten the business acumen, those who can be able to move into funding, they get seed capital through partnership with MasterCard Foundation for them to start their business. So that is another engagement that the bank was doing. We are currently in discussion with MasterCard to just re-engage on how this can work. The initial program closed end of 2024, and we're in discussions to just see how much more we can do in 2025 as we progress. The other partnership that we've also done is working with like-minded corporates to then say, how do we support your value chain, especially those who do not have ability to repay. So for example, we worked with EABL, we worked with Unilever, we worked with the major oil companies. Cumulatively, we've got 327 large corporates that we've entered into partnership to say, how do we use the business records that the large corporate is keeping to support them, the value chain. So for example, if I go into the EABL, East African Breweries Limited, we finance EABL as a corporate. We also engage the distributors, who are the main beer distributors across the country. Then we go to the stockists based on the records from the anchor. So your local pub may not have sufficient records to qualify for funding. But because of the model we've gotten with EABL, we are able to finance those local pubs up to 2 million shillings for them to work with EABL, because you're taking comfort that EABL has a regulated model of how they run their business. And on that basis, we are able to finance you. So as I said, we have got cumulatively 327 ecosystem engagement that we then support businesses that have potential, but then on the basis of our 14 lenses, they may not qualify to support for business.
So what I'm hearing is there are different initiatives already ongoing to support business people. It is you as a business owner to ensure that, but he's even mentioned a few. There's the Young Africa Works, which ended, which now you're trying to work on. World International has also initiatives that support you to put your business together. And also there are as many things as a business owner you can plug in. Thank you so much for the nuggets. I want to throw just one thing. Give us a best case scenario or a worst case scenario you have seen, if possible. You don't share the details, please. I don't want data finding on my desk, but a business, probably a best business case scenario or a worst case scenario of a business you have supported or financed. That probably it was something that was right before their eyes and they were missing it.
Thank you. So there's a gentleman in, and I'll use Gikomba. There's a gentleman in Gikomba who was running a business venture, and this business was importing bells in bulk, and he could do about 10 bells, 10 containers a month within Gikomba. And when this customer came to us and sought financing, one, he did not have sufficient collateral to cover for that business, and two, he was running that business as an individual. So what we did is, since he needed collateral and the amounts of money that he required were quite expensive, we went back to look at how does his business operate, and we understood the cycle. He gets about 5 to 10 containers. They come into the country. He has to pay KRA. Then he has to deal with the local engagements, and most often within 5 days, he's cleared all his stock. So what did we do with this customer? Because he needed more money, but the structure of the business, we couldn't, by virtue of how the business was structured, we couldn't give him the money. So we asked him to get into an agreement with the suppliers from the UK. And what we were doing with this UK supplier is we gave this customer what we call letters of credit. Letters of credit is an undertaking by the bank on behalf of this customer to tell the UK supplier that if you bring these containers to June and they arrive into the port of Mombasa in the form and shape that June will agree with, we will immediately pay you. So what happens then is he was able to get 2 times the number of containers he could get on cash basis. So we gave him an additional supply, and the bank's comfort was we were to cover what is the possible risk when we put out this money, because this customer of ours does not have collateral. The first risk is we send the money to UK and that person disappears into the streets of UK. We will never find that person. But now, with the with the payment being subject to the goods landing at the port of Mombasa, we were safe. So our own letter of credit acted as collateral for this borrowing. So the moment the container landed in Mombasa, again, one arrangement that we had with this customer was we will give him the duty money to pay KRA, but we will not give him the cash directly. Once he's done with the KRA paperwork, we'll pay KRA directly on his behalf, and then he will get the papers from KRA. So that was an additional borrowing that we gave this customer, so that the moment the goods land, the transport, logistics, and KRA, we paid for them because we had to work with a specific shipping company, so that we pay the shipping company for the logistics and we pay KRA for the goods. Then the local transport was up to him. Once these goods landed, based on historical sales, we could see this customer paying for these goods in the 5 days. So that is how we supported that customer. Remember, our business is not just giving money, we also give advisory. So one of the advisories we gave this customer was, please take insurance against your goods, because you never know what will happen. So with our SME insurance cover, this good customer of ours took business, several. The SME insurance cover has it covers about 7 aspects. It covers fire, it covers burglary, it covers theft by servant, it covers WIBA, work injury benefit. So there are about 7 benefits into that insurance. So when the week our customer picked up insurance and we maximize, he took the stock cover on the basis of the maximum loan he can get, because that is the easiest way we'll have arrived at a value. Guess what happened? A fire in Gikomba happened. And the good side of this is the insurance that we had put in place was able to cover him within 7 days for the full value of the amount that he had lost in terms of stocks. How did we arrive at the stock level? We used his import documents for the last 5 months to document the average period it takes when he gets stocks and sell. And that is how we arrived at the value, potential value for compensation by the insurance company. And he was paid off. When I look at this kind of customer, I'll probably position that as one of the most impactful or successful support that we've given a customer. The benefit also that we gave to this customer is for his 15 employees within the business, because he has a warehouse and a shop. We also got them into salary financing. So we do not just finance this business customer. We also used his business records to give personal loan finances to his members of staff, about 15 of them. So while you see somebody seated in Gikomba as just an assistant, through the engagements that we had in partnership with a land selling company, these 15 staff, they all got facilities to buy plots. One of the people say mtu ni ploti. So what we then did is these 15 employees were advanced money through the bank, because we had to put them together, and taking cover from the employer, we did finance them to purchase plots. So in a natural context, they will not have qualified to get those plot purchase financing in somewhere in the outskirts of Nairobi. But courtesy of this arrangement with the employer, who is a Gikomba trader, the 15 people bought plots within the outskirts of Nairobi. And I think, if I remember very well, about 4 of them have already put up some form of home within that land. I thought that would be an example I put on the table of a successful engagement with our customer.
That definitely is. I want to do a round of applause, because very relatable SMEs that we engage. I saw last week, was it Toy or Kibera, Gikomba that also banned again, and the fires have been very recent. And something businesses don't know, taking an SME business insurance cover. They'll come assess your stock and all that, because also maandamano happened last year and a lot of businesses were very, very affected, and you go back to square one. So Equity Bank has also mentioned they do offer an SME bank insurance cover. Mr. Kirinya, to you, a worst case that turned into a good case, in 2 minutes as we wrap this up.
All right, maybe ours are even more than Collins, because we work with SMEs almost daily. I can think of an SME who was not very clear about the business model. And when we're talking about such a person, the person I have in mind, it's somebody who's been running a business not for 1 year or 2 years, for even more than 5 or 6 years, but they've never actually been able to articulate what their value proposition was. Because many of the SMEs that we come across tend to be very product centered. And then of course, they'll come and tell us, how do I sell more of my products? But you have to step back and ask them, a product is a solution to a problem. So what is a problem? So I think what I can say in a nutshell, because I have a very, very few minutes, once we brought in clarity about this is what your business model is all about. It's not about selling product A and B. It's about solving this problem. All of a sudden, the client saw immense opportunity. And once they tracked that immense opportunity, of course, the revenues began to rise. Now, what I want to say is the client had a valid business model, but I don't think they had sized up the opportunity that well. And they are kind of like giving up. This thing is actually not making sense. So we find ourselves in that situation so many times, where we are giving a business a lease of life because of certain amounts of clarity that we have brought into the business. So I've anonymized the information as much as possible. So
I think one thing they would like to know is, what was the key support you provided that was like a lifeline or a sense of direction to this business?
Okay, excellent. Our core product really is strategy as well, international. So we say, as a business, whether you're running a business or not, first and foremost, a business is a bundle of risks and it's a bundle of opportunities. Yeah, which is why Collins has to pay attention to the risk side before they give you a bit of money. But how do we help businesses specifically? It's in the area of strategy, and we also say that every business owner is a strategy practitioner, whether you've gone to school or not. So how we helped the client in particular is in the area of strategy. First, to help, and how do you approach strategy as well international? We push back to you and ask you, think about the problem that you're solving in the market and for who. And then based on this, I think by a process of inference, this is what ought to be. If this is a problem you're solving and for this kind of people, I think this is the way you should respond to that problem. And then we help you figure out now, what do you need to put together to solve the problem? We help you think about a competitive strategy. How will you survive competition? And then most importantly, we close the process by uh, helping you to push 3 questions about client acquisition. Number one, and it's a very practical question, where are your clients most likely to be found? Are they at KEPSA? Are they at Wild? Are they at Equity? Where are they most likely to be found? And then the second question that we are going to push across to you, once we are okay with everything else that has come before, is what's the best way to reach them? Yeah. Are you going online? Are you going to set up a shop or whatever else? And then the third question is, when you find those clients, what are you going to tell them? Because some of us are very clear about the problem you're solving. We probably have excellent solutions, but we're not able to communicate that. And we found that a lot, June, that sometimes we are not able to communicate the value that we create for businesses are not able to create the value to communicate the value that they create. We found that a lot. So those are the key areas. We help you think through strategy. We are not in the business of writing documents, so don't come looking for strategic plans, but you can come for strategy. You can
Thank
come
you.
for strategy. Yes.
I can see
So, and then I'd like to add,
yeah.
uh, the thing is, since all SME owners are by default strategy practitioners rather, the only difference is whether they're doing it right or wrong. Yeah. So once we align their strategy practice into the right thing to do, then of course we expect them to make progress in so many areas. June?
I'm seeing even Jesse has already put a link to book a strategy session. He has said you're not going to live with a strategy plan. So book a session. You could be in the desert somewhere and a lot of things are confusing, but with the right strategy, you're able to plan what are your next steps. I want to take questions on the chat box, which one starts. The first question was actually for you, Mr. Krinya. Anthony is asking how to separate profits, expenses, and loan repayment installments. Is there usually a specific formula that one can use?
I think Collins already alluded to that, and he talked about a metric called the debt service coverage ratio.
Yes.
So when you're talking about, so let's start with profits. Yeah. So profits is the surplus you get when you have this income and you have these expenses, and there's a profit. So the thing is, are we repaying the loan from profits or from cash flow? So for me, I think we are supposed to pay the loan from what? Cash flow. Yeah, because the thing about profit is that there are two aspects about profit. And maybe Collins, I'll come back to you so that you can chime in on the debt service coverage ratio. There are two things about profit here. So there is accounting profit. June, you can sell a product on 1st of January, and it's captured in your books, but you receive the money on 31st of December. Yeah. So in a sense, because you bought the product for 100 shillings and you sold it for 200 shillings, you've made a profit of 100 shillings. Right on the 1st of January, that is accrual accounting. For the purposes of thinking about loans, let's move away from what we call accrual accounting. You've made a book profit, but there's no cash because I've not paid you. I've not paid you for the service that you offer. At the end of the day, it is not profit that repays your loan, and it is not profit that pays your expenses. It is cash. So you have to find a way to think more cash. Profit is good because you don't want to make a loss. You have to think more about cash and then not confuse cash, accounting profit, what we call accounting profit or book profit, with cash. Like that example I've given you. In the meantime, for instance, you've sold me the phone for 100 shillings in 1st of January, and I have not paid you up to 31st. So now that I have not paid you, how have you been looking after your salaries and your rent and those other kind of things? But now to narrow down to loan repayment, I think Collins is the expert on that one, and I think he can talk about the debt service coverage ratio and how it's computed and why it's important.
Thank you, Rinya. I only want to confuse my audience with the full calculation, but in summary, the debt service cover ratio is to look at, out of your total sales, how much of that can go to pay the loan in simple arithmetic. So for example, if you are selling at 500 shillings, how much loan can that sales amount of 500 shillings be able to be used to pay for a loan? So that is just how the debt service cover ratio comes. One item, Kirinya, that I can add on this conversation is when there's investment, people call it time value for money. If you sold in January and you're only getting this money in December, assuming you put these 1,000 shillings in a fixed deposit account or a savings account, how much interest will you have earned? So if you had 1,000 shillings and you'll have put it in a fixed deposit account that gives you 10% a month, is between January and December, you'd have gotten about another 100 shillings. So by getting your money in December, the time value for money is that is the 100 shillings you'll have lost. So you can imagine, if you get your 100 shillings in December, and that 100 shillings you have gotten in January, that 100 shillings in January was worth 100 shillings. It was worth 200 shillings in December because you'll have the 100 shillings that you are receiving in January and the 10 shillings every month. So what you're getting as 100 shillings in December, if you got it in January and getting the 10%, you'll end up having 200 shillings. That is how I'll simplify the time value for money perspective.
I'm seeing all the other questions that we have here have been tackled, but thank you so much for answering that. Not paying your loan based on profit, but on the cash you have, because you still do require to pay it when the date has come to pass. I'm seeing you have also, Mr. Collins, you have tackled the questions on it. There's Mwararia Gitonga who actually raised a question that you gave a case study for, which is very coincidental. Can your bank consider financing a startup whose client has issued an irrevocable letter of credit against their invoice, but lacks substantial financial records at the moment? I think you gave a very clear case study on the same. So if there are no other questions, I don't think there are other questions that have been. Okay, Philip has a question. Are there tailored loan products for smallholder farmers or agri SMEs? And does that apply differently for agricultural loans? Does the moratorium and terms apply differently?
Yes. Allow me start answering. I think there's somebody had mentioned that I'll answer in the plenary.
Okay.
I can't remember her name. Was it Rebecca or something?
Yes.
So she asked about when she has plots, but can we give her money?
Mm-hmm.
So Rebecca, I'll break your heart. We can't give you money just because you have plots. And the reason being, banks don't give money on the basis of collateral. We give money on the basis of cash. And the reason we don't give money on the basis of collateral, Kivinji has just told us that we pay loans from cash flow. So relating to that, when there's no cash flowing in your veins, in the veins of your business, I can't advance you money. But why do we ask for you to contribute money before we put in money? So the bank says contribute 20% before we will finance 80% and you put in 20%. It's because if you do not put your contribution, you will not see the desire to complete that project. I repeat, if you don't put in your contribution, you will not have any loss potential to lose because the project has not completed. So the main reason the bank asks you to put that 20% is so that you can also feel the pain if this project does not go through. In simple terms, because you have something to cling on and you don't want to run away from something you've invested. So that is one of the main reasons banks, I'll say for like us, insist on putting that condition. So I thought it will be easier to explain that from a conversation. I think it was Rebecca, if I remember the name right.
Yes,
Now
it is.
I'll come back to agriculture financing.
Mhm.
We have a full-fledged department that just focusing on food and agriculture, with a director in charge of that and a complete set of teams to focus on that. And the reason for us is because food and agriculture is a very integral part of the economy of this country. Within that food and agriculture department, we have about 14 value chains that we focus on. There's dairy, there's tea, there's it's these days called blue economy. Blue economy has some bit of fish, has some bit of the sea works. So cumulatively about I think there's 17 engagements that we do that. So what we've observed then is, for farmers, we tailor the repayment to suit the product cycle. So one, when it's times for planting, we'll provide you the money for planting. When it's time for putting fertilizer, we'll give you money for the fertilizer. When it's time that requires you to do, so we'll give you the input financing in the life of the facility. So I'll not give you, so for example, if I approve 10 million shillings for you for the farming engagement, I will not give you all the 10 million. I'll give you the money in bits and pieces for each phase that you need to do. What is the benefit to you? You only pay interest for the amount you'll have exposed yourself for the period of the loan. So it gives you a saving on the loan. And equally, we tie the loan to the period. So I will not call it a moratorium, because there's no way you can pay earlier. If you're harvesting tomatoes, if you're planting tomatoes, you have to harvest the tomatoes to sell them for you to pay me. So we then structure the loan installment towards that kind of cycle. And June, allow me to do an advertorial here. Currently, we have an arrangement with CIFAO, who are doing the case structures, and you are financing 90% financing for the case structure for a period of 60 months, and they give you a 1-year insurance for free. So that is the kind of partnership that we've then gotten to say, how do we support agriculture mechanization? And also, we have a team of 5 whose full-time job is engaging customers on agriculture mechanization. And finally, on the same line of agriculture, we have a webinar that's coming up in the course of June. I don't have exact dates. It's June, and you're called June. So June, I'll share with you that invitation for those things, so that you can share with the members on this call, those who are in agriculture, so that they can attend that webinar on irrigation. So we've put in quite a number of people to come and just talk to our farmers about irrigation. And probably just to close on that, this year alone, we've had 4 different webinars that just focusing on agriculture. Last month, we had a webinar that was focusing on farmers who are keeping animals and how they can take care of the hides and skin. Because most of the time, we've been told that those hides and skin are thrown. But remember, those hides and skin is money. So we had a webinar that just took farmers around that. And then we also had a webinar that took farmers towards just doing soil testing and understanding what happens on their land. So those are items I can share with you, June, and then you can share with the KEPSA fraternity to attend.
Right. Thank you so much. I don't know if Mr. Kirinya, you have anything to add?
Not really, just to circle back to what you said about cash flows. At the end of the day, when you're taking the loan, you need to be confident that your business is going to generate that kind of cash to sustain the loan and plus your day-to-day. And remember, also alluded to the fact that when you take a loan, you're increasing a claim on your cash flows. There are others who already have a claim on your cash flows. And of course, this is Africa, June. In addition to your suppliers and the bank, there's also the relative who wants to be paid for fees and those other kind of things. So this is Africa. We also need to be realistic when we're doing our forecasting. There's a formal, and then there's also the informal side of things. But just to circle back to Collins, I think that example that you gave for the client in Gikomba, just the way Equity Equity Bank has interacted with that client at very, very many touch points, and that the bank is big enough to do that. That is the approach I think financials should be taking to supporting enterprises. Understand me. From the bank's point of view, we have 10, 20, 30 items that I need to tick. But from my point of view, as an enterprise who is looking for funding, I want you to understand me. I want you to understand my business model, and I also want you to understand me as an entrepreneur. So I think when we marry those two things, there's a lot more opportunity for SMEs to access funding. And at the SME level, what I'd like to say is don't treat cash forecasting or cash flow forecasting as a nice to have. It's a need to have, because it helps you to anticipate ups and downs of your business and then prepare in advance. So to fail to focus, what I'd like to say is to fail to focus is to expose yourself to unnecessary surprises. That's what I'd like to say, June.
Thank you. Fail to focus. It's like planning to fail is failing to plan. That's the same sentiment. Collins, I don't know whether you have contacts to anyone, probably your customer service, who you could drop on the chat box. I know Wild have dropped their contacts there, so that, because I'm seeing there are a lot of agricultural SMEs here, and also even other SMEs in different sectors who would want additional assistance. So if you have a contact that must not be yours, so that probably they don't call you 24/7, but if you have a contact for someone who can guide them to the respective persons, please, if you don't mind sharing that on the chat box, especially for the agricultural SMEs, for them to reach out to. I'm coming to a close of the session right on time. I want to drop just a few poll questions, even as we come to the end, and thanking our speakers so much. I know there's a lot that we have learned from this session. There's a lot of nuggets. So let me just launch a poll and see what has been your insight. Did you think that this session was insightful to you? I saw someone say, I wish they knew this before they took a loan. But now, as Colin said, they ask for a skin, your skin in the game, so that you also feel the motivation and the pinch to still go after what you are seeking for. One thing I have learned on my end is that, SMEs come to us, even as KEPSAs, we support SMEs, and they're like, you connected us to a financing entity and they're not financing me. And you ask them, what did they say? My credit, my cash flows are very low. And they say, but I have collateral. And Collins has put it very simply, we don't lend you because of your collateral. Because you could have a piece of land. A piece of land is those things we call long-term liabilities. It may not be able to offset it in a year, but we lend, or they lend you because of your cash flows. You could have land, you could have a car, but if you don't have where you're getting your money consistently, then they cannot be able to support you. So I like the fact that, yes, for those who are asking about the links for the recording, they will be shared to you via email. We have a program called Ginwe Growth Program that we're also running with MasterCard on our end that is offering financing to businesses. But the metrics, all that Collins and Mr. Krinya has shared, are the same things that are used cutting across board. It has favorable interest rates, yes, that's for sure. But that is still what they will look at. What are your cash flows like? What is your business model? As Mr. Krinya says, how is your business structured to run? And those are still some of the things we look at. Is there your skin in the game to be able to finance you? So what has been shared today still cuts across all financing entities. So thank you to the 35 of you who have responded. I want to pose, I just have 2 more questions to run. I asked a question in the morning, have you taken a business loan? For those that said yes, if you have an existing loan, have you learned something that you didn't know when you applied? Because there are things that I had people say, cases that you have a credit officer and you go, SMEs, you go and cook your books. And you cook your books and then you're given money and then it affects you. So is there something new that you have learned that you didn't know when you applied? I'm seeing also some comments on the chat box. I'll also be checking on that. The session was great. Thank you for the feedback. A question to you, Mr. Kirinya. Are the strategy sessions charged? I'm seeing on the chat box someone asking, if I want a strategy session, is this charged? Yes.
Excellent question. Let's have a discovery session first to find out whether strategy is a thing that you need. But remember, I alluded to earlier that you're already in the space of strategy if you're running a business, and then we can tailor something. So I think the best thing is to start with a discovery session so that we can have a feel of what really needs to go to your strategy. But as you wait for that discovery session, just know you're still practicing strategy. And the question is whether you're doing it rightly or wrongly. So let's have a discovery session first before we discuss the value, and then after that we can discuss the costing.
Okay, thank you very much. So sign up for a discovery session. Sign up for our discovery session. I think what you've just mentioned is what is actually scheduled for my last question for the day, even as we proceed. Do you think your current financial status, based on what Colin said and Mr. Krinya, your financial discipline or your business model support a business loan? Some of us are saying yes. 13 say yes. 3 are saying no. 4. Those who are saying no, and also those who are saying yes. Mr. Krinya says, you all have a strategy. The thing is, are you practicing it correctly or wrongly? Book an exploratory meeting just to examine. Collins has said they have a session and not only on agriculture, they have different sessions coming up. So they will be sharing that, and we will be also channeling that your way for you to get to know what they have in store for you. I can thank you for your engagement as well. I can see 19 of you are saying yes, your current financial status, discipline, and model supports your business loan. 10 of you say no. Let's not be shy of being truthful and honest with ourselves, and that enables us to explore. It could also be working, but have you reached your full potential? This is where you get to know that. Thank you so much for your engagement today, and for also just showing up today for this session. We hope we are able to organize another session, probably on something different, and still have our 2 amazing speakers joining us next time, and we will also communicate the same. The recording, as I stated, will be shared via your emails. I know the contacts and the social media pages for both entities have been dropped on the chat box. So feel free to follow them. So feel free to follow them. Feel free to get in touch. Also via their contacts. I will also just be pulling this and sharing the contacts via email as I share the recording for you to be able to reach out to them. I hope there's no question that I have left out, but I want to say a massive, massive thank you to Collins and Mr. Krinya as well for making time today. 2 hours goes by really fast, especially when you're having a very interesting and engaging session. Thank you so much for making time. And we hope to also progress this discussion a bit further. Asanteni sana.
Thank you very much, June, and
you.
the participants. Thank you.
Thank you, June, and have a good morning.
You too, and have a blessed week as well. Asanteni sana.